this week, they were maintaining a cautious approach to cutting interest rates, echoing the minutes released on Wednesday. Now, this comes as a reaction to January data showing inflation stayed unexpectedly high, pushing back hope of that first rate cut to June. So let's bring in Matthew Luzzetti, who is the Deutsche Bank Securities Chief U.S. Economist, to discuss more. Matthew, always a great pleasure to get some of your insights here. First and foremost, I mean, we were thinking May, now we're pushed back to June. We actually had Brad McMillan on here with us earlier. He said you might want to take the probability of a cut just off the table this year. What are some of the readings shifting in terms of your stance?
Yeah, we've been expecting that the Fed would cut rates in June, and I think certainly the recent communications that we've gotten from Fed officials, which are right, have leaned hawkish, have supported that. I think when you look at some of the Fed officials, certainly Vice Chair Jefferson yesterday, Governor Waller yesterday evening, they're looking at the data earlier this year, a strong jobs report, very strong jobs report, a big pickup in inflation, a stronger than expected Q4 GDP report. I think they're concluding two things. One, there's no urgency to cut rates. The economy is performing well. Why do they need to ease back on monetary policy restraint given that? And two, there is some more significant uncertainty about whether or not inflation is on a downtrend. We got that strong January inflation report. And so they want to see additional data points really to get confidence that inflation is going back to 2% before they begin to cut rates. We agree. I think that likely happens at the June meeting.
Matt, what did you make of those two reports that we just got? Are you still confident that inflation is cooling despite those blips?
Yeah, I think that there was a number of idiosyncrasies within the data. So owner's equivalent rent within the shelter component was very strong within the January data after showing this clear downtrend. I actually do have decent confidence that that is going to reverse, and over the next year, shelter inflation comes down. We know from all these private sector estimates that they've disinflated very materially, and actually in some of those estimates are in deflationary territory. So I think some of that will come down. Other components, portfolio management within the PCE inflation gauge actually tracks the market. So as markets move substantially higher, it leads to inflationary pressures, but that's just a transitory story. So we still do have reasonable confidence that inflation will come down over the course of this year. But I think you do have to acknowledge at the same time, you got a strong print and there's some greater uncertainty around that.
What type of, and when we think about that trend that we're trying to watch so closely to see if and when it's locked in, even if we did see that trend get locked in, how quickly would the Fed feel the propensity to need to cut as long as that trend is remaining kind of in line with moving towards their target?
Yeah, I think they've signaled that from a risk management perspective, that they don't want to cut rates too early. They're seeing an economy that is performing well, financial conditions that are quite easy with equity markets at record high levels. So there's nothing really pushing them kind of urgently to move. At the same time, they do believe that policy is restrictive. We do see some of the stresses that may cause either through regional banks or CRE or consumer delinquency rates rising. And so I think from the Fed's perspective, they have what looks like a soft landing in hand, and they are still concerned that if they don't begin to ease policy somewhat, at least over the coming meetings, that they could potentially jeopardize that and that it transpires into something that's a little bit more adverse.